looking at the Bank of Canada rate updates, they're looking at two main factors. Smart money goes into properties that are going to properly cash flow for you. The market is stuck between the reality of 2020 and 2021 and the reality of the now.
Welcome back to the Markets and Leaders podcast. I'm your host, Lyndsay Malchuk. Now, there is a part of the market that almost nobody talks about at the dinner table, rarely trends on social media, and yet quietly dictates the direction of nearly everything people are trying to make sense of right now. From housing affordability to equity valuations to where capital is actually flowing behind the scenes. That is the bond market, and more specifically, what is happening with yields right now, because this is not just a technical shift or a line on a chart. This is a repricing of money itself, and when the cost of money changes, every asset class has to adjust whether it wants to or not. The question is not just where yields are going, but what they are already breaking, what they are quietly reshaping, and where that creates opportunity that most people are still missing. And that's exactly where today's conversation sits. Joining me for the first time right here on Markets and Leaders podcast is someone who works directly in that flow of capital, navigating the relationship between fixed income, real estate, and broader market strategy in real time. Michael Succurro, founder of Spark Financial, has built his career around understanding how money moves when conditions tighten, when risk reprices, and when traditional assumptions about borrowing, lending, and investing start to shift. Michael, it's so great to have you here. Welcome to the show.
Thanks for having me. I'm excited to be here. And, before you kick it off, I just want to say, I wish I was at those dinner tables where no one's talking about this, because every dinner table I'm invited to, everybody keeps asking me about bond yields and the rates.
Well, that's because you're in the space. Also, I'd like to be at the dinner table you're at because I'm guaranteeing that it's probably the most amazing Italian food, too.
It is. I got to admit. I'm very picky on where we go.
Oh, gosh, here we go. Okay, wait, we've digressed. Now, before we go anywhere, I want to reset this conversation in the simplest way possible, just for a brief second, because the second people hear bond yields, they're gone. So let's pretend I'm not in the media, I'm not markets, I'm just someone sitting across from you asking a very basic question. Michael, what is a bond?
Yeah, no, it's a great question. And I get asked that all the time because, again, I'm explaining to clients how the rates work and what they're reflecting of as to how we come up with the pricing. Not myself, but how the lenders come up with the pricing on how to offer these rates. So a bond is just another investment vehicle that large banks, large investors, even everyday people can invest in, that fluctuate on the market, just like any other stock, any other equity, any other mutual fund you would see out there. But this bond yield is what's backing our fixed rate mortgages.
Okay, so when people hear yield, what does that actually mean? Is that just the return you get from lending your money?
Yeah, well, the yield is just like in any other investment. It's what you're going to be yielding off of that deal. So the 5-year bond yield is going to yield you X amount of dollars.
Yield
So
would
right
mean
now,
your return.
speaking, it's live. Yield a return, yes.
Okay. So if we strip all the language away, a bond is basically you lending money, and a yield is what you get paid to do just that. Yeah?
Exactly. To put it in simplest terms, as a product that everybody knows, is when you're giving the bank money to invest in a GIC, a guaranteed investment certificate, the bank is taking your money to go lend it out or use it for leverage. So they're going to say, hey, we're going to pay you a 2% yield for the next 4 years, because they know they're going to hold your money for the next 4 years, and they're going to lend you. They're going to lend that money out and make money on your money. That's how the banks work, and that's how they make their money. So that's the same thing with the bond yield. That's why the bond yield affects the fixed mortgage rates, because that's what the banks are using to lend that money out. That's what they dictate. Okay, we need to make X amount of spread. So it's just like the Bank of Canada prime rate.
Yeah, so that's a really great example. Let's actually make this even more real. If I can lend my money and get paid more to do it, that sounds great. But the problem is, when that number goes up, it changes everything else, doesn't it? So help me connect this. If I can earn more just by lending money, why does that create pressure across the entire market then?
Well, it creates pressure because now it creates a rising cost of borrowing money. So if you're that end user that ends up receiving the money that's being lent out, you're getting it for top dollar. So to give you a simplified version of it, the Bank of Canada always releases a Bank of Canada prime rate. And it's always, right now it's at 2.25%. So they're like, okay, well, we're not going to lend the money out at 2.25. That's what we're getting it at. That's what we're going to offer it to you. So the banks are getting that money at 2.25. They want to make their spread. And that's where you're getting the variable rates. That's why the rates are at 4.09 right now to 4.25. Before this call is at 4.36. I looked at it. They're fluctuating every day. But that's the bank making the spread on the money that they're borrowing.
Okay, got
So
it.
they're carrying on that cost to the end user. And that's how the banks make their money. So it's the same thing. Anybody could become that investor. They could become the bank. That's a whole other topic where it's called private lending, but you're passing on that cost to the end user.
Ah, okay. Why does that make things like real estate stocks, even businesses, feel tighter? Because I think this is where people are confused. They're sitting there thinking, why does everything feel more expensive? Why does it feel harder to move forward financially? Why does it feel like money just isn't going as far? Is that directly connected to this one shift?
It's primarily directed to this one shift because, again, this shift affects the entire economy in the sense that, again, when we're looking at the Bank of Canada rate updates, they're looking at two main factors: what's unemployment at and what's inflation at. And as of right now, they're saying on the next announcement, they're most likely going to actually increase the rates because inflation keeps climbing. But what might hold it back is that unemployment is also climbing. So they're trying to find the happy medium. So why it affects the entire market is, again, you look at gas prices. So the cost of gas goes up, which now puts strain on the market, less buying power for people. But if they're going to buy anything, they want to charge them a higher rate to purchase that because, again, everything is at an all-time high. That's why you see the
Right.
groceries are going up because gas
Absolutely.
is increasing, which is being passed on to the client, not the client, sorry, which is being passed on to the consumer who's buying these foods because now it's going to cost you X amount of dollars for your food to get from point A to point B. They're using way more gas, which is costing them way more money.
It's crazy. It's crazy. I saw this meme thing, and it was like, if you want to smell expensive, just head to the gas station and do a little dabble on your wrists and behind your ears, and there you go. Now you smell expensive. That's where we're at right now.
Exactly.
Let's bring this into real estate because this is where people feel it. I mean, if I could afford a home 2 years ago and now I suddenly can't, that's not because the home changed, it's because the cost of borrowing the money changed. So are we essentially watching affordability get reset in real time?
Ideally, yes. Yeah, that's exactly what you're watching is affordability getting reset because, again, money was virtually free during COVID times. I call 1% to 1.5%
100%.
rates because you yourself as the bank could borrow against the home equity line of credit and go lend that out at 2.5%, and now you're making a 1% spread on your money. It's better than any stock market vehicle. It's better than any mutual fund, any equity you could get into because, again, it's backed by real estate. So it's like, why wouldn't you do that? And that's what happened. And a lot of people use that vehicle in a smart way, but a lot of people use it in a really bad way as well. One of the biggest things, I was talking with pool contractors saying they were turning down jobs because they're so busy. And that's what was happening. People were saying, let me give a lender credit off my house and redo the house, add a pool, add whatever it may be. And these things don't add value to your property.
They don't really?
No.
Well, maybe in a jurisdiction like, I don't know, California or Florida or something, I feel like everybody has a pool or has to have a pool. But here in Vancouver, maybe not so much. In Ontario,
Well, until your
definitely
property
not.
taxes go up. So that house for me is less desirable.
Ah, gotcha. Okay. So I think here's where people get a little bit more confused then. Prices haven't fully dropped, but buyers have pulled back. Maybe because of pools. Who knows? So
Yeah,
what is actually happening right now? Is the market stuck between two realities?
it is. The market is stuck between the reality of 2020 and 2021 and the reality of the now. And what I mean by that is buyers, again, I always say buyers have short-term memory loss and so do sellers, that they just think in small increments of what happened in the past. So someone that bought their house they're like, well, this person on my street sold for $2 million. So I want $2 million. Well, no, they sold 5 years ago for $2 million. The market shifts. But these people don't have to sell. They're holding out on that sale. Whereas buyers now are saying, well, money's not free anymore. I really don't care to pay $2 million for your house. I'll offer you 1.7. And you're stuck in that, you know, slippery slope that who's going to budge first.
That's
Now,
so
where we're going
true.
to see who's going to budge first is people don't need houses. They can go rent if they feel it's overpriced. But people need to make their payments. So if they can't afford to make their payments anymore, then they have to drop their price so they can sell the house and not get power sale and foreclosed on.
And I think that's I
That's
mean, we're seeing
the
that here.
goal in there.
We're seeing it here in Vancouver. I don't know if you're seeing it in Ontario, probably, but you're having these houses that are sitting on the market long enough for them to make the decision to drop it down $20,000, $50,000, $200,000 because they're like, I got to move this off my books. It's incredible. What are you seeing over in Ontario right now?
It's the same thing we're seeing. The ones that are motivated to sell are the ones that have to because they can't afford the renewal and they can't afford the mortgage payments anymore. And I don't think we're at the bottom of it yet. I think the bottom is still going to be, it's going to be coming in the near future in the fall market. That's what I'm predicting. So the advice I'm giving to people right now is if you can't afford this payment, you have to sell ASAP because I just see the values are going to be coming lower and lower as more inventory is coming into the market. And that's what we're seeing. So yes, our real estate market was up 7% in April, which is great in sales. But I still don't see it as a true number because it's up 7% due to the fact that a lot of people are listing. There's a lot more supply. And there's been people that have been waiting on the sideline for the last 5 years to buy and just enter the market.
Do you think this is the time to buy?
If it's a good price, yes.
Well,
Look, rate
always
wise,
the
I don't think
case.
we're going to be getting any better rates anytime soon. Because
Okay.
again, short term memory loss. When I was doing mortgages from 2015 to 2019 pre-COVID, the cheapest rates we had were 3.1 and the highest they were at was 3.9. Before
Whoa.
COVID happened, I was selling mortgages at 4.1% and nobody was batting an eye at it.
That's the thing, I was, talking with someone and they recently said they went out maybe 2 years ago, 3 years ago, and they went for a steak, and they paid, like, I don't know, $50 for it, $40, whatever it is. They went back to that same one just last year, that same restaurant had the same steak, it's now $70, and I think what's happening is it almost feels like the entire economy got used to money being so cheap, and now suddenly it's not. But it's also setting a new bottom line, and I wonder if people are just adjusting, just maybe at different speeds. I mean, is that a fair way to look at things?
I think it is, but also, one of the comparisons I always hate that people bring up is like, oh, rates in the 90s were reached 18%. Yeah, that's great, but the prices were also 70 to $100,000. You can't. It's not apples to apples. You know what I mean? So, where it's more comparable to what I'm saying is that from 2015 to 2019, rates were varying from maybe 2.9 is the cheapest, but all the way as high as 4.1. That was the norm. Nobody was going crazy about it. Whereas now people are like, oh my God, these rates are horrible. They're not. They're at the normal level. They're at the historical level for what the prices of homes increased to. You know what I mean? 18%, yes, it sounds crazy, but again, they're purchasing a home for $70,000. That same home now in some areas is $2 million. So yeah, 18% on 2 million, that's ludicrous.
Yeah, 100%. So
But
when this all
4% on 2
happens,
million isn't really insane when you look at how much these homes appreciate.
yeah. So when this all happens, when, money used to be cheap and people are just sort of making the adjustments and suddenly money becomes a lot more attractive again, I mean, where does smart money go? Because if I can earn a solid return with less risk, why would I take the same risks I was taking before?
Yeah, smart money goes into properties that are going to properly cash flow for you. And what I mean by that is, again, not, spending take the same $2 million instead of buying a $2 million mansion that you're not going to be able to rent out if you had to, and cash flow. Take that same $2 million and buy maybe a duplex, a triplex, a fourplex, whatever it may be that's going to generate cash flow.
So you
So
can
in
get a
market,
duplex for $2 million in Ontario?
sorry,
You can get a duplex. You can get a mansion for $2 million in Ontario.
like a mini mansion, 4,000, 5,000 square feet.
Okay,
Depends where you want to,
it's like
look.
wow.
Well, in this market right now, yes. I'm seeing
Totally,
properties that
actually,
are
touche.
85 by 200 square foot. 85 feet by 200 foot lots, 5,000 square feet with a 3-car garage going for 1.6, 1.8.
Okay, I think I'm gonna move to Ontario. Just kidding. Would never do that. Let's
A
be
lot better than
honest.
Vancouver. A lot better than BC.
Nope, nope, not at all. Okay, I completely digressed. Let's flip back to your thing. Are we seeing an actual quiet shift happening right now within the markets and people just adjusting?
Yes, you're definitely seeing a quiet shift right now. And what's happening is that, again, there's these houses that are being sold quietly at a discount because banks are offering them up to, high net worth investors saying, hey, we're power center of this property. It's worth $1 million. We'll give it to you for 800. We want to get that off their book. I just think that that funnel is getting tighter and tighter as how long they can keep that quiet. And it's just going to hit the mass market soon. Just here's a crazy amount of supply that is going to be hitting the market because people just can't afford the renewals anymore.
Let's talk pressure. Because when money
Yes.
gets more expensive, something eventually cracks. What typically breaks first in a cycle like this? Is it real estate, consumer spending, over leveraged businesses? I mean, where does the stress actually show up first?
Well, I think the stress shows first in consumer spending through groceries, entertainment, all those aspects. Again, talking about Ontario and Toronto specifically, the restaurant industry, they're saying 30% of restaurants are just breaking even right now.
Really?
Yeah, and majority of nightclubs and speakeasies, or forgetting the other term right now, but those ones that are like half a nightclub, half a restaurant. They're either again breaking even or losing money right now. The only thing that's really going to save them is this summer with the World Cup coming, because you just have so many people coming all over the world. I think that's going to be the saving grace for them. But I bet you if there wasn't the World Cup, you'd be seeing a lot of, again, popular restaurants. I'm not talking mom and pops. I'm talking franchises. I'm talking all these nightclubs that would be shutting down. That's just my opinion. I think the World Cup is going to create a little bit of a mini economy boom for us.
It will. It will. Do you think it'll be sustainable, though?
No.
It's the thing, right?
The World Cup's for a month, and that business is going to be gone. Yes, you're going to have the summer that booms. It's funny because if you look at historically, they actually say the signs of a recession is when people are actually spending more on alcohol, booze, and entertainment.
Okay.
These are depressed. So what are you going to do?
What are you
You're
going to
gonna go
do?
drink.
You're going to numb it.
Party. But yeah, a lot of you're seeing the consumer spending tighten up there first because like, okay, well, we're not going to go for as many dinners anymore. We're not going to go party anymore. We're not going to go to as many concerts anymore, whatever it may be.
Well, if there was some good music out there, then I maybe would think about spending the money on concerts. Just saying. Okay, we've been deep in this, but markets aren't just numbers. They're actually behavior. They react, they hesitate, and they definitely overcorrect. So I want to see how well you can read that behavior when it sounds a little more human, we'll say. So here on Markets and Leaders, we always love playing a fun little game. And this game we're playing today is called Bond Market or Midlife Crisis. So here's how this works. I'm going to read you a statement and you have to tell me if it's something coming out of the bond market right now or someone going through a full-blown midlife crisis. So no overthinking, only humorous, first instinct. Ready?
That's good.
Okay, first one. I used to feel stable. Now I'm questioning everything. Bond market or midlife crisis?
Bond market.
Tell me quickly why.
Because the market's just unstable. Gas is like a penny stock right now.
So it's a midlife crisis.
$3.65 today, $2.40 tomorrow. You never know what you're going to get. That alone is unstable.
Okay, next one. I was way more attractive when things were cheap. Bond market or midlife crisis?
Bond market. Everybody likes something a lot cheaper.
This is true. In midlife crisis, money is no question.
Exactly.
Okay, number 3. I keep saying I've peaked, but then I surprise everyone again. So I'm going to say this again. I keep saying I've peaked, but then I surprise everyone again. Bond market or midlife crisis?
Still definitely the bond market, because right before this call I took a look at it and it peaked like you wouldn't believe.
Okay, I would say like midlife crisis for that one. Midlife crisis. I keep saying I peaked, but then just wait. Look over here.
Yeah.
Jazz hands. Okay. I don't trust anything that moves too fast anymore. Bond market or midlife crisis?
Midlife crisis.
What? No way. Midlife crisis. They always want the red sports car that goes fast.
I don't know. I think now they just want low and slow, but I don't know. Maybe you're right. They want to go fast.
Okay. I need higher returns to feel secure. Bond market or midlife crisis?
Midlife crisis, because they're spending money like crazy, so they need that high yield.
Right? Just making it rain. That's right. Okay. I look calm on the outside, but internally it's pure chaos. Bond market or midlife crisis?
Midlife crisis. The bond
100%.
market doesn't have any internal. It's showing you all the time.
100%. I agree with this. 100%. Okay, last one. And I need an explanation with this one, okay? I thought I had everything locked in, and then everything repriced overnight. Bond market or midlife crisis?
That's the bond market.
Okay, what happened there?
What happened there is, I don't know, Trump sent out a tweet. Carney reacted and made a
I was
news,
waiting to see how long this would come.
Made a news appearance about nothing to do with the economy. And all of a sudden it peaks and gas goes to $3.
Go. Okay, that might be the most honest explanation of the bond market we've had so far. Let's bring it back to reality, though. If someone is watching this right now, Michael, what should they actually be paying attention to? Not 10 things, 1 or 2 signals. What tells them things are stabilizing and what tells them we're not through this yet?
One thing to look at, I'd say maybe more specifically on the real estate side, because again, the bond market, you can't really look to that. Because like I said, it spiked today because there's a certain comment made, and it could very well go back down tomorrow. So that's a short-term signal. A long-term signal would be pull up Realtor.ca, do a 500-meter radius map around your house or your location you're in, and see how many listings there are. Because when the market's hot, there's going to be 4 listings. When the market's like it is right now in turmoil, there's going to be 14 listings. And that's going to show you who's testing the market, who needs to get out, who's struggling. Because when the market's hot, the listings are flying off the shelf right now. Click on a listing, you can see 120 days listed, 88 days listed, 45 days listed.
Okay, what was the website again?
Realtor.ca.
Realtor.ca. Is that a shameless plug, or is that like?
No. I wish I owned that website.
Okay.
We're the only ones making money in this market.
This is true. Okay, here's where I want to end this. In a moment like this, where things feel uncertain and harder to navigate, what gives you confidence right now, Michael?
What gives me confidence right now in the market is there are still smart enough investors out there, and a lot of people that listen to the experts that are out there that are making the right choices. And also there's still a need for people that want to buy at the end of the day. Nobody wants to rent forever. And there's still people that have that appetite, and they're understanding that this is where the rates are at. And, there are good deals out there. That's what's giving me confidence, is seeing, a 7% uptick in the real estate market last month.
Cool. Okay. Well, Michael, this was a very important conversation, especially because we broke something down that most people hear about, but really have no idea what it actually means. So thank you again. And definitely come back soon. We're going to make this a regular thing, okay?
That was great. Thank you for having me.
And to everyone watching, if things feel tighter right now, there's a reason. Money isn't as cheap as it used to be. And when that changes, everything else adjusts with it. The advantage isn't in reacting late. It's understanding what's actually happening while it's happening. So here is the fine print. Remember, these are the opinions of our own with possible vested interest in any or all of the companies we speak about. Always be sure to speak with a licensed financial advisor and know your own risk tolerances. This is not to be used as financial advice, and for a copy of our complete disclaimer, head over to apperton.com. And as always, understand the rules and you'll understand the game. I'm Lyndsay Malchuk, your host right here at the Markets and Leaders podcast. Subscribe now to catch all our episodes. We'll see you soon.